The Quiet Revolution: How BlackRock is secretly building tomorrow's financial infrastructure. What if I told you that while everyone's been obsessing over Bitcoin ETFs and whatever dog coins trending this week, BlackRock, the world's largest asset manager with over $10 trillion under management, has been quietly orchestrating the most significant transformation in financial infrastructure since the invention of Swift. I'm talking about a stealth operation so sophisticated that most crypto YouTubers haven't even noticed it's happening. But here's the thing. I've been tracking this story for over 18 months, diving deep into regulatory filings, partnership announcements, and technical integrations that paint a picture of institutional adoption that's not just coming, it's already here, processing real transactions worth billions of dollars. Let me take you back to early 2022. Picture this. I'm sitting in a Manhattan coffee shop, scrolling through what seemed like another routine BlackRock earnings call transcript. But buried in the footnotes was something that made me literally put down my coffee and read it 3 times. Larry Fink wasn't just talking about tokens as the next generation for markets. He was laying out a blueprint for digitizing the entire global financial system. And the infrastructure he was describing, it already existed. The $47 million signal nobody saw coming. In mid-2024, BlackRock quietly invested $47 million in a company called Securitize. Now, before you scroll past thinking who cares about some random fintech startup, let me explain why this matters. Securitize isn't just any platform, it's the transfer agent for tokenized securities designed from the ground up to comply with existing securities regulations while integrating with custodial and transfer agency services. Within 40 days of launching their BUIDL tokenization fund on Ethereum, BlackRock hit $640 million in assets under management, making it the world's largest tokenized fund at that time. But here's what nobody talks about, and this is where it gets really interesting. Ethereum's limitations became immediately apparent. We're talking transaction fees that spiked above $70 during network congestion, settlement times averaging 15 to 30 seconds, and energy-intensive consensus mechanisms that made corporate risk teams break out in cold sweats. Enter the silent infrastructure revolution. While everyone was fighting over Ethereum's roadmap and Solana's latest downtime, something remarkable was happening in the background. The XDC network had been quietly building what I can only describe as financial-grade blockchain infrastructure, and the numbers are staggering. Let me paint you a picture of what this actually means in practice. Sub-second finality with block times under 2 seconds. Transaction fees of approximately $0.00001. That's 1/100th of a penny. Sustained throughput exceeding 2,000 transactions per second on testnets. 0 major network outages since mainnet launch in 2019. But speed and cost are just table stakes. The real magic happens when you understand the compliance architecture. XDC isn't just compatible with ISO 20022, the global financial messaging standard that underpins Swift and is mandated by over 11,000 financial institutions across 200+ countries. It's architected around it from day one. Think about this for a second. Every major bank, every central bank, every clearinghouse in the world communicates using ISO 20022. It's literally the language of money. And XDC speaks it natively, without translation layers or middleware hacks. By embedding ISO 20022 compatibility at the protocol level, XDC offers seamless integration with traditional banking systems, a critical factor for any institution looking to leverage blockchain without extensive re-engineering of legacy infrastructure. The Corda connection, a multi-trillion-dollar bridge. Here's where this story becomes absolutely fascinating. R3's Corda platform isn't some obscure blockchain experiment. It's the distributed ledger trusted by over 300 banks and financial services firms, including household names like HSBC, ING, and NASDAQ. These institutions process trillions of dollars through Corda networks for trade, finance, derivatives, and securities trading. I had a revealing conversation with the trade finance officer at a major European bank last month. Due to NDAs, he couldn't name specific partnerships, but he painted a picture of settlement rails that just work. No drama, no surprise downtime, no fee volatility, just institutional-grade plumbing that processes transactions faster than traditional systems while maintaining full regulatory compliance and audit trails. The breakthrough came in August 2025 when XDC announced a production-grade Corda bridge. This isn't theoretical infrastructure, it's live, processing real transactions. A proof of concept conducted with SBI R3 Japan demonstrated that cross-chain atomic settlement could occur in under 5 seconds compared to the multi-day traditional processes that currently plague international trade finance. This architecture allows digital asset transfers on Corda to settle with finality on XDC rails, effectively making XDC the financial plumbing for interbank settlements and trade finance applications worth trillions annually. The Archax revelation: $1.2 billion in 60 days. But here's where BlackRock's strategy becomes crystal clear, and the numbers are absolutely stunning. In February 2025, XDC Network and Archax, a UK-based digital securities exchange regulated by the Financial Conduct Authority, jointly launched tokenized money market fund tokens representing shares in 4 institutional funds managed by BlackRock, State Street, Fidelity, and Aberdeen. These RWA money market fund tokens reached over $1.2 billion in assets under management within just 60 days of launch. Let me repeat that: $1.2 billion in 2 months. To put this in perspective, that's faster adoption than most traditional investment products see in their first year. I've been tracking the wallet addresses associated with these funds using on-chain analytics, and the pattern is unmistakable. We're not seeing retail speculation here. These are large, methodical accumulations consistent with institutional treasury management strategies, the kind of steady, disciplined buying that happens when pension funds, sovereign wealth funds, and corporate treasuries make strategic allocations. Archax's CEO specifically highlighted that XDC's ISO 20022 compatibility and permission validator framework enabled them to meet stringent FCA regulatory requirements without sacrificing the interoperability benefits of a public blockchain. The global expansion, building institutional corridors worldwide. While crypto Twitter was debating which meme coin would moon next, XDC was systematically building a global institutional network that's reshaping how international finance operates. In Singapore, XDC integrated with the Infocom Media Development Authority's Trade Trust Framework, enabling the issuance of MILLIONAIRES compliant negotiable electronic trade documents. This targets the $15 trillion global trade finance market, where small and medium enterprises face an annual $1.7 trillion funding gap due to paper-based inefficiencies. The results from early pilots are remarkable. TradeFlow Capital used XDC's trade network to tokenize bills of lading and execute a $25 million digital assets-backed financing against 7-day cargo shipments, demonstrating the end-to-end process from token issuance to secondary market liquidity. InvoiceMate completed a private credit pilot, tokenizing receivables worth $1,000,000 for small and medium enterprises in the UK, achieving financing approval in under 24 hours compared to the customary 14 to 21 day process. In Brazil, XDC announced a collaboration with the state-owned IT services firm Serpro to develop a blockchain-based KYC AML verification layer, reducing onboarding times from weeks to hours. The government of Zanzibar selected XDC as the blockchain infrastructure for its national blockchain sandbox, experimenting with land registry tokenization and digital identity pilots. The technical evolution: XDC 2.0 Aurora. The September 2024 deployment of XDC 2.0, dubbed Aurora, introduced capabilities that address core institutional concerns about auditability and accountability. The upgrade introduced formal on-chain governance via staking pools that can be revoked in cases of malicious activity, advanced smart contract auditing tools built into the protocol, and on-chain forensic monitoring capable of reconstructing transaction histories in real time. Security firm Hash Laboratories conducted a comprehensive audit and described Aurora's consensus modifications as the first systematic approach to achieve functional accountability within a Byzantine-tolerant system. This means that malicious nodes can be identified and slashed without impacting overall network liveness, a critical requirement for institutions handling sensitive financial data. Under the Aurora protocol, Organizations can configure validator pools comprised of approved entities such as licensed banks or regulated custodians while gaining the transparency and immutability benefits of a public ledger. The European validation. Regulated investment vehicles. In April 2025, 2-1 Shares launched the XDC Network ETP on Euronext Paris and Amsterdam exchanges, offering institutional and retail investors regulated exposure to the XDC token. The product reached $75 million in inflows within its first month, a clear signal of growing institutional appetite for blockchain infrastructure investments. I've been analyzing European institutional allocation patterns, and there's a definite shift happening. These aren't momentum plays or yield-chasing strategies. These are strategic infrastructure bets by institutions that typically operate on 10-year time horizons, recognizing that the rails supporting tokenized assets will be as valuable as the assets themselves. Meanwhile, Libre, a Luxembourg investment firm, announced plans to issue tokenized investment funds on XDC, including strategies co-managed by BlackRock and Brevan Howard. While these products target high net worth and institutional clients, they represent a departure from the predominantly US-centric regulatory landscape of tokenized securities. The network effect. Exponential growth in real usage. By mid-2025, the XDC ecosystem had reached remarkable scale. The network had processed over 801 million transactions, produced 89 million blocks, and hosted 178,000 smart contracts across 261 validator nodes. But these aren't vanity metrics, they represent real economic activity. The network's Nakamoto coefficient exceeds 100, meaning more than 100 independent entities would need to collude to compromise consensus, a level of decentralization on par with mature public blockchains. Average transaction fees remain at approximately $0.000408485, while block times average 2.0099 seconds with finality within 30 seconds. Host distribution spans multiple cloud providers including AWS, Azure, and Google Cloud, plus dedicated data centers and private enterprise servers across 20 countries. This geographic and infrastructure diversity mitigates platform-specific outage risks and regulatory concentration critical factors for institutions with global operations. And you guys, I have a special trick for you which nobody seems to be using, and I cannot wrap my head around why. Because if you sign up through my link down in the description onto the BuyDefi exchange, you get a 10% deposit bonus, and now stay with me here. Now, here comes the important part. If you have any trading capital on any other exchange, and you move it to your newly created BuyDefi account, you get on top of your capital. You moved another 10% extra trading capital. As an example, if you move or deposit $10,000 to your account, you get a $1,000 for free. And here is why this is possible. BuyDefi makes money on trading fees. The more capital you have, the more you trade. The more you trade, the more they earn. So they're literally investing in your trading activity by giving you extra capital up front. And unlike other platforms where bonuses are in the 1 to 3% range, BuyDefi's bonus is a full 10%. I am not kidding. I really don't understand why nobody is doing this. To me, it really seems like people sometimes are too lazy or just don't like free money. I kindly ask you to pause this video and take your time to make an account. You can thank me later in the description of this video. Alright, let's jump back into the video. The tokenomics, designed for institutional predictability. XDC's economic model reflects its institutional focus. The network's total token supply is capped at 37.7 billion XDC, with an annual inflation rate currently set at 7%, declining by 1% each year until stabilizing at 1.5%. This predictable inflation schedule is governed by on-chain consensus rules and cannot be altered without stakeholder approval through a multi-signature governance mechanism. Approximately 20% of annual issuance goes to staking rewards, 10% to ecosystem development grants, and 70% to network operations and validator rewards. This ensures that protocol improvements, security audits, and compliance tooling receive continuous funding without reliance on external venture allocations. Only KYC, AML-verified entities can operate validator nodes, creating a permission validation framework that mitigates concerns about anonymous, potentially malicious actors. Major financial institutions, including Archax and Digital Asset Holdings, have announced intentions to run validator nodes, the stealth integration strategy. BlackRock's approach isn't about making headlines, it's about building infrastructure. Rather than issuing press releases, they've layered XDC integration across custody and wallet providers who support XDC-based tokenized securities, execution venues with backend connectivity to OTC desks and token exchanges, and backend infrastructure where corporate clients never see XDC but experience its performance through familiar interfaces. It's like ordering delivery through your favorite app. You don't care which delivery company picks it up, you just expect it to arrive fast, cheaply, and reliably. BlackRock's clients will never know XDC is under the hood, but they'll experience 2-second settlement times and sub-penny transaction costs. The competitive landscape. Why XDC stands apart. When you compare XDC against alternatives, the institutional advantages become clear. Ethereum Layer 2 solutions average 10 to 20 S econ finality with volatile gas costs of $0.05 to $0.20. Solana offers approximately 400 millisecond finality at $0.0005 cost, but lacks native regulatory features and has experienced multiple network outages. Hyperledger Fabric provides strong enterprise features but has no token economy. XDC delivers approximately to second finality with costs under $0.001, combines a mature EVM-compatible ecosystem with built-in trade finance modules, and offers zero-knowledge proofs plus compliance modules at the protocol level, alongside established partnerships with trade finance leaders globally. Looking ahead, the $16 trillion market, research firms project that by 2030, tokenized real-world assets will represent a $16 trillion market, growing at a compound annual growth rate of over 74%. As this transformation accelerates, the networks woven into the back-end software of banks, fund managers, custodians, and trade platforms will determine the future of digital finance. XDC's corridors are already processing live pilots across tokenized bonds, commercial paper, CBDCs, supply chain finance, carbon credits, and private equity interests. Each successful implementation creates network effects that attract additional institutional participants. BlackRock didn't stumble upon XDC through some crypto Twitter thread. They methodically evaluated blockchain networks against institutional requirements, EVM compatibility for familiar development tools, sub-second finality for high-frequency trading operations, near-zero fees for cost-sensitive workflows, and enterprise-grade compliance for regulatory approval. Their approach represents invisible orchestration, embedding XDC into custody, trading, and clearing infrastructures, so that trillions of dollars can flow through its rails without fanfare. While retail investors chase price charts and speculative narratives, the largest capital allocators are building highways for the tokenized economy. Institutional finance is constructing digital infrastructure behind the scenes. When you trace the routes that tomorrow's trillions will travel from tokenized bonds and real estate to carbon credits and trade receivables, the map converges on networks that can speak the language of legacy systems while unlocking the efficiencies of distributed ledgers. XDC Network has positioned itself as the foundational blockchain for this transformation. Those who recognize these quiet corridors today will understand why BlackRock's strategic alignment isn't just smart, it's inevitable. The revolution isn't coming, it's already here. Processing real value through institutional-grade rails that most people don't even know exist. If this deep dive into institutional blockchain infrastructure opened your eyes to what's really happening behind the headlines, hit that subscribe button. Next week, I'm breaking down the technical architecture that makes institutional tokenization possible, with live demos and exclusive interviews with the engineers building tomorrow's financial infrastructure. The future of finance is being built in quiet corridors, not flashy conference stages. Make sure you're following the right signals.